Hello, everyone. Thank you very much for attending FLIA's Real Estate Direct Lending and Private Debt Forum. Today is season 3, part 6. I want to thank all of our sponsors, Boomerang Capital, who is presenting right now, Dream America, Apex One Investment Partners, GSH Real Estate, Prequin, and EI Ventures for helping us making this event possible. Without your support and guidance, we would not have been able to produce such a high quality and great event. Thank you to all the people tuning in today to this meeting, and the FLIA board for your support. It's amazing how this community came together to provide leadership, over the past 2.5 years since the outbreak of COVID-19. I'm proud to be the founder and chairman of this group of great men and women, and we are dedicated to bringing you thought leaders, from different niches inside of the alternative investment world. Today, with regards to real estate, it's the greatest strength of the U.S. economy, and it's definitely been the driving force since COVID-19 has hit. We have a great group here, Boomerang Capital. They are going to start off today with their presentation on value-add loans on single-family housing. With that said, I'm going to turn it over to Rob, so that he can, introduce his team and get the presentation started. Rob Jaffick, CEO of Boomerang Capital. Rob?
Thanks, Michael. It's great to be a part of everything that FLIA is up to, and we appreciate not only your support, but we've had a number of people become interested in us and become part of what we're doing here, and we greatly appreciate them. And not only, you, Michael, and, the investors, but we really have been introduced to a great group of competitors. I guess frenemies, right? Half friends, half enemies, but we definitely have, I think in any industry, there's people that you admire and really bring out the best in you and, show you how best in class works and those sorts of things. And we definitely have found that in the FLIA community. So we appreciate the entire community. What Boomerang does, Boomerang Finance, we provide financing on single family residential homes. As we've discussed in other places, that has really evolved from, it was first off, it was kind of flip, and then it was fix and flip, and really now it's become value added. Our borrowers provide an important service to the community to take homes that are not ready to be lived in. They're old, and it's not just aesthetics, it's the roofs, it's the plumbing, it's all of those other sorts of things that need to be updated and upgraded so that they become into move-in condition. So along those lines, and we understand that a number of people do the same thing. Family offices, apparently about half of family offices do lending on the side one way or another. So we thought we'd talk a little bit about what's going on in the markets and a little bit about, hopefully very, very much unconventional, but hey, you want to do it yourself? Let's show you how to do it. We understand some of you are doing it. So what we do and what you can do. So really the biggest thing that, you kind of have to start off with is housing prices. Housing prices have indeed ripped. So this is the Case-Shiller index, and you can see there it is. It's ripped quite a bit. So what to do at this point if you want to continue to participate, and how should you participate, and how can you get involved in that? The time to buy a portfolio of single family residential houses is probably past. So how can you get involved? So one of the ways you can get involved is more on the lending side. And the risk characteristics are different. We think they're very favorable. So we thought we would unconventionally show you how to do it. So David, put us out of business.
Yeah, that's great. Well, hey, why not, right?
Yeah, exactly.
No, this will be good. So we just want to show you a little bit about, how to do it, how to do your own lending. And so, first of all, just walk you through the scenario of a home. You have two options, right? I think we're all here because we're interested in the real estate industry. We're interested in debt. So here's a scenario of a home. It's a $400,000 home. And so you've got two different positions you can be in. You can either own that home, and there's your value that you have of $400,000 now invested. Or you can be in an equity position with debt. And so now you've got $120,000 in, but you've got a $400,000 asset. Or you could be the debt position, and now you're using $280,000, you're making a return. And so you're 70% of that home. Well, let's just say, the wonderful 2008 excitement came around again. Well, what would happen if that were the case? Well, let's just say a 20% decrease in the housing market. Well, if you were the pride owner of the home, your value is now $320,000. Or if you were the equity partner, this is where it really hurts. If you had debt on the property and you had 120,000, this is where we show that, leveraging up is sometimes, that's where it creates risk. Your 120,000 just dropped down to $40,000. And so you now have a third of the value that you had before. Now, if you're in a debt position, this is my favorite position. I'm a debt guy. I love debt. I think it's a great tool. I love lending money, and it protects the downside. That's, it's kind of like insurance, right? We're trying to protect our downside, make sure we make a return. But in the end, all that hardworking money that we've earned, we want to be able to hold on to it. We want to protect it from taking that loss. So the great thing about debt is it gives us the ability to still invest into the market, into something that we really love, but do it with the protection of protecting those monies for the future. So let's just say you want to do this. Let's say you want to lend money. You want to get into this debt business. Well, the first thing to do is be able to choose a product. What do you want to lend on? So there's all types of assets. We could do fix and flip, rental, long-term, primary residences, which pulls a lot of different fun items into the picture. So such as Dodd-Frank, as many know, that has caused a lot of disclosure requirements and made it very difficult to be able to lend to someone. Most times someone that's looking for a hard money loan on a primary residence, they're not qualifying based on Dodd-Frank. So you got to find a way around that still semi-qualifies inside Dodd-Frank. Bridge loans, those are great. They're short-term, being able to bridge the gap. Gap lending in a second position. I will say I'm not going to talk much about gap lending except right here telling you stay away from it. Here's the deal. Let's just say you're in second position to Boomerang Capital partners who lent the money in first. If that's the case and the borrower defaults, my rate was 12%, but now my rate's 29%, and I'm going to eat up that second real quick. So the goal of default interest is to be able to secure the asset. It's to be able to make sure that you protect anything that may happen. It's also to make up for maybe some losses on a different property. So it will eat up the second position pretty quick. And so understand what is in front of you and what the terms are if something does happen. Or if it does default, have the liquidity to be able to buy out the first. That's the most protective way to do a second lien. Commercial assets. Commercial assets are great. They're a lot more sophisticated borrowers typically to deal with, and so they understand they understand what you're looking for, what you need. They're going to provide stuff a lot easier, and so, but at the same time, it's a lot higher dollar amount. So you got to put out a lot of money to do that. Accounts receivable. This is a lot of manpower to be able to manage an accounts receivable in order to manage whether it's factoring and making sure what assets are in and out, and being able to on a month to month you got to know what your assets are. So equipment financing. I actually love equipment financing. There's all price points of equipment. You could be in the aggregate business, or where they're trying to they're breaking down rock, and each machine that's sifting that rock is costing, $150,000 to $300,000. Or you could be in the printer business where it's a $20,000 printer, or maybe big printers, $1 million. So there's all types of financing inside there. What we understand and what we love and what we're in the fix and flip business. We're in the rental long-term, short-term. However, we're just the acquisition. So we're the bridge from beginning to end. We specifically like the short-term because it provides the protection of many things. If the market changes, our loan is only 6 months. The market takes, and Rob can correct me, over 2 years to be able to truly take from, top to bottom. So there's all, so realistically, so we've got the ability to adjust. Fix and flippers, a lot of the good fix and flippers survived the last crash because they sold their properties quick. They didn't want to hold on to them. They wanted to make sure that they got their cash back in their pocket. So short-term loans we like. Long-term, they're great, but just look at the interest rates, and your returns have to go down in order to do that. So we like high returns. So that's where we get into that short-term financing. So once you've decided what you want, and let's just say you're going into the real estate loan and you want to do exactly what we're doing, where do you find the borrowers? Well, luckily there's in every market there is a RIA, so Real Estate Investors Association. What they do is they are educating investors, and so all those new investors coming into the market pretty much get connected through a RIA, start meeting people. It's a great place to connect to them. Every time I go to an event, I'm usually meeting a new investor that wants to lend in the space, and so they're trying to get to know borrowers. The problem is, I will warn you, the people that I will not lend to, from lots of experience, are the person that's going to approach you first. So you got to be very careful of those first connections that you're going to make. They love to latch on to that new money. So. But there's a reason why we're not lending to them.
There's another, other places you can go find deals and stuff. You can buy leads off the internet. You can, network other ways. Believe me, if you go handing out $20 bills, or you say I got $20 bills in my pocket that I gotta get to work, stuff will come out of the woodwork.
That's right. And so we're going to talk a little bit about the underwriting side, but first, my favorite side is the negotiation side. I love, that's why I do this. I love negotiating. I try to be the one that can run the numbers in my head before they can run the numbers, and outplay them so I can charge more. So just an example, I use this in a lot of different realms when I'm talking to borrowers, when I'm talking to people that want to lend, whoever it may be. These are terms of lending, and as you're looking at this slide, I want you to look at each word and find the word that sticks out to you. Which word is really grabbing you? And what I typically find is that word that's sticking out to you, that's your pain point. That is the word that bothers you. When you go to get a loan, that is what you want to negotiate. That's what you want to fight. So for instance, let's just say the borrower is speaking with you and their pain point's origination fee. So your typical rate, ours is 12%, and then with a 1 point origination fee, which, if it's 6 months, that's a 14% APR, or if it's shorter, it starts going up, or if it's longer, maybe it goes down, or you charge fees on the back. But that origination fee, if that's what's the pain point, okay, well, I'm going to charge you 14% and no origination fee. Now your pain point's gone, and we've got you at 14%, and all things work out, right? I'm still making the same return. Or let's say it's the junk fees. I hate junk fees. I hate seeing those. It's really easy to be able to build that into the rate and the origination fee. If it's down payment, well, I can connect you to a second lender to come in. I can connect you to someone that can be able to help with providing that down payment, but stay within your terms, right? You want to be able to keep things where they are. But all in all, these are the things that, as you're negotiating, these are the words, and your goal is to be able to figure out what is what matters. So there's two types of terms here. One is something that doesn't create more risk, and one creates risk. So for instance, loan to value, loan to cost. Let's just say you go to a higher loan to value, loan to cost. Well, that's going to increase the risk of the loan. And so you can offset that with interest rates, but that really didn't mitigate the risk. All that did is allowed you to get paid more for your risk, so you can put more aside, maybe in a debt, in a loan loss reserve to protect you. But in the end, our goal is always to mitigate the risk, create more, be able to do something to mitigate it. So for instance, if they can't put the money down on the loan or put down enough money, well, then maybe we need to go get an additional piece of collateral, right? Maybe we need to do something in order to actually mitigate our risk and protect us. So these are all terms you gotta find out what mitigates risk, what doesn't mitigate risk, what is just charging more. Make sure you make as much of a return as you can, and get the deal that you want. The next one is now going in and originating loans. So we found the borrower, we negotiated terms, we came to with the final terms on the loan. Now we need to decide if it's a good deal. The problem is you did all that and you kind of promised, hey, I'll make this happen, but then you got to underwrite them and find out, is this worthwhile or not? So first of all, this is the worst part of it all, in my opinion, is licensing. Yeah. So either A, find a state that does not require licensing. There are states that do not require licensing based on what type of lending you do. If it is truly a business purpose loan, an investor buying a property, there are states that do not require licensing. However, if you look at a lot of the hot markets, a lot of them do require licensing because they've had some type of history of us lenders making, or we have a bad reputation sometimes for back in 2008. So because of that, licensing came about. So you've got to get the right licensing, protect yourself compliance wise, and do that. You also need loan docs that will protect you. I can't tell you how many times somebody's found a set of loan docs and just decided to use them. I'll say we made that mistake early on. We were lending in a state that we weren't in, and we asked the title company to provide us a note and deed of trust. We reviewed it, and in the end, it did not provide the protections that we thought it did. And so that put us at risk that we weren't ready for. And so finding the right loan docs, making sure that they're protected. There's a lot of places you can go. To be honest, you can go online and go to something like eforms.com, or going to one of the LegalZooms or some type of company. They can do it. But there's attorneys that specifically work in this space, and they can produce the loan docs. And if I can just give you one piece of advice, it's to go to that attorney and have them draft the documents, whether it costs $400 to $650 for that loan doc package. It's worth that protection and making sure you have the right protections in the state you're lending. Underwriting. This is where we're gonna get into where we can lose money, right? So you've heard when you buy real estate, you need to or when you're doing real estate, it's all about the buy, right? That's where you make your money, is in the buy. It's not in the sell. Well, that's same with lending. All the money made is in the underwriting. If you have bad underwriting, you can lose all the money you made on, we don't make a whole lot per loan. And so one loss could offset 6 other properties if you make the wrong decisions, or you really chose the wrong property. So you need to determine what matters to you. Well, does a credit score matter, and understanding what the credit score is? Or is it what's on the credit report that matters? Does a background check matter? So to us, things that matter is tax liens. We want to know, whether they're paying their taxes, whether they're doing what they're supposed to. We want to know whether they have judgments outstanding. Are they having lawsuits, in a bunch of lawsuits over different items? What doesn't matter to us is credit score. Almost all of our borrowers have bad credit scores because what they're doing is they're using their credit cards. They're drawing them all the way out in order to do these deals. It's just part of the deal. Like when someone wants to be able to leverage up, be able to go do deals, they're going to put it all on the line in order to make it happen. So So you need to determine what matters there. What we really think matters the most is the asset. We are an asset-based lender more than anything. So we're looking at what the underlying asset is. So what matters is the valuation. Well, I can tell you from history, we've done enough loans to have quite a history of what this number is, but we've done appraisals on properties and that's for other purposes, for banks, for collateral lines of credit that we use. And we've done BPOs so realtors going out and giving you a price opinion. But on every deal, we have 3 people in our office that run a value on a property. So the loan officer runs a value, a supervisor runs a value, and one of us in the management runs a value to verify that we're okay and comfortable with the property. Historically, we have been within a very small tolerance. We typically run on the conservative side of what the sale price is, with somewhere between 3 to 7% conservative on the sale price. On an appraisal, it is within $50,000 either way. It's rough. Appraisers are good at appraising a property as it sits. They do not know they don't appraise a future value well, and technically they're not allowed to value a property as a future value. So it makes it very difficult to rely on them.
And that's where Zillow got sideways.
Yes, algorithms, right? And
that's right. You don't need people. Just let the machines do it.
Hey, it's all good, right? And
Exactly.
We'll see what happens. And there's a lot of valuation tools online too. Use them as a source, but you need to run and find your own comps. Find your own comps to see what it is. Budget, scope of work. You got to know how they're going to get to the end of the project, how they're going to come up with the money to get there. Is the scope of work right? Just yesterday, I was underwrite. I had a loan officer bring a deal in, and we were looking at it. The borrower wants to put $300,000 into the property. It was now going to be worth $1.5 million. So it was a high-end home. Well, we looked at it and we saw that there was an opportunity all you need to do is put $100,000 into it, and it would only be worth, in that case, about $1.2 million on it. But there was still enough upside, and the risk went way down. So, in our mind, we looked at it, and that's how we were willing to lend on it. It's okay if he wanted to go the other way, it was okay, but some other lender could do that loan. So ours, we want to look at protecting that downside once again. Clearing title, that's very important. You want to make sure you have a title policy, owner's policy, and a lender's policy on the deal. And we've had to deal with title claims, and when you deal with the title claim, I just want you to know that you're probably going to deal with it for 12 to 48 months, somewhere around there. You never know. It takes a lot of time to get money back out of a title company. And then lastly, never overlook insurance. We had a borrower recently that had an insurance policy. It lapsed. We had been calling him, letting know it was going to lapse. We reached out to the insurance company. I guess he had reached out to the insurance company as well. Long story short, he had never actually called. He had never finalized insurance. We had a 10-day period, actually less than that, really. We had a small period where he did not have insurance, and his house burned down to the ground. Luckily, in this situation, this is a borrower that had some financial strength. Luckily, he bought the property right. His losses were very minimal. We took no losses on it because we're in a debt position with a personal guarantee. And so those are things you got to protect yourself and make sure you have. And I'm going to fly through this last slide here. Servicing loans. Your choice is to outsource or insource that. The problem about outsourcing is you now lose that relationship management, being able to take the fees and earn the fees. All that goes to the outsourced agent. So, but at the same time, you don't have to deal with it, right? So you're not implementing new software. You're not going through compliance training. You're not having to do all the calculations. You don't have to manage the defaults if they come. And so they take care of all that. But at the same time, we have found that by having a relationship with our borrower, our default rate is so much lower than anyone else because we are servicing, they're calling the same company all the way through the loan. And so that's where our defaults are, 0.5% versus the industry average of somewhere around 2%. So it makes a big difference being able to have that relationship. So, I mean, all that said, you can go do this yourself. It's a fun business. I love it. It's something that you can enjoy, or at the same time, you can consider being in a fund structure. That's what we love to provide, and work with us on that. I always am looking for those guys that come to the real estate investment events and they're coming with new money to come lend out. And I always come tell them, hey, go sit on the beach. Let me do it. You're going to make the same returns, like mine, or better or worse, depending on how everything goes. As a fund, we're able to keep the capital deployed at all times. That's a huge difference from, you can charge and make the 14%, but then your money's going to sit for a couple months until you find the next deal you're comfortable with, and then you got to go deploy it again. Diversification, hundreds of loans versus one loan. Let's say you lend one loan. Well, as a percentage, let's just say the default rate's 2%. Well, that means 1 out of 50 loans is going to be bad. Well, what if that one loan you do is the one, right? It is what it is. You've now lost money. Whereas, we've proven history that we can lower that default rate by our processes, and now your returns, now the losses are less. Also, they're spread across hundreds of loans, right? So now 1 in every 200 for us, right? So the losses are very, very small. Also, as a fund, it costs a lot of money to set up a REIT. I think, just true hard cost was just over $100,000 plus, all the other things that we had to go through in time and effort. And so adding that up, it's a lot of money to set this up. But in the end, REIT gives us structure of being able to have qualified, being able to essentially lower your tax liability on the deal. You get a little discount there. So in the end, we've shown you how to go do lending. You can call me, ask more questions about how to do lending. I want to make sure if you do, I want you to protect your money. I don't want you to go lend to some of these bad guys out there. They are there. We just had one in Arizona where he went from lender to lender getting loans, and long story short, every one of us foreclosed on him at the same time. And there was a second on every one of them. The seconds are losing all their money. And so we want to make sure to protect you and protect that. So thank you for listening and going through how to become a lender.
Yeah, and if you have any specific questions, if you want to go sit on the beach instead of doing this yourself, we do love it. It's a lot of fun. But if you'd rather do that, reach out to David or I or Chris. Chris is a dedicated resource, can help you get everything figured out, get in front of any of us with specific questions. If you're not sure whether it's a question for David or a question for me, Chris knows most of the answers anyway, but can get you where you need to go. So with that, Michael, I don't see questions. I think there's a problem with the queue there. So, but we are also at time, so we will turn it back over to you and appreciate you and the team.
Thank you so much. This is Jeremy.